Good morning, everybody. A very warm welcome to F1F9's Financial Modelling for Renewables webinar. My name is Andrew Barclay and I'm a director at F1F9, and I'm joined by a number of colleagues this morning, I'm delighted to say, two of whom, Alex and Dhruv, are working in the background to make sure that the webinar runs smoothly. And I would like to kick off the webinar by asking Alex to run a poll that I would like everybody who's listening so far to take part in. So Alex, would you please put the poll up on the screen? And what you can see, I hope, on your screen is a question, a quick poll. What's your interest in renewables modelling? Are you a, and you've got a number of options to choose. Are you a developer, investor, funder, advisor, or something else? And I'm going to invite everybody on the call to complete that poll. So if you could do that now, please. And I'll just wait 5 more seconds for results to come in. And Alex, I wonder if you could show the results of the poll. So I think a good spread of results. We seem to have a majority of advisors on the call, but a good spread across developers and investors as well. It is very good to have all of you on this webinar. Thank you for completing that poll. Very good to have all of you on the webinar, and very much hope that you find something useful as we talk over the next hour. A little bit more about me. I said my name was Andrew. You are most likely to see me teaching F1 F9 financial modelling classroom courses, and I've been with F1 F9 for 7 years now, running courses for most of that time. And you're likely to see me at F1 F9's upcoming financial modelling for renewables course in London on the 15th and 16th of January. And I'm also joined by my colleague John. John, I wonder if you could introduce yourself, please.
Yes, good morning. I'm very pleased to be here. You might have noticed, though, that I think Mark Ringrose's name was up on all the emails. Unfortunately, Mark is unwell today, so I've had to step into his shoes. I'm also a director at F1 F9. I've got 20 years of modelling experience in infrastructure. And unlike Andrew, my focus is more on working with clients to build models. And today we're going to be drawing on the experience of building and solving around 80 renewables models in solar, wind, hydro and other sectors, and using that experience with you today.
Wonderful. Thank you, John. It's very, very good that John has stepped in at last minute. So thank you for that, John. Now, a couple of housekeeping points. The webinar is going to last for about an hour, and we will be recording the webinar, which we'd be delighted to make available to you a little while after the webinar has finished, probably tomorrow or the following day. You've also got a handout available to you to download, which is in the webinar menu. There's a section called handouts, and there's a PDF which you can download and refer to as we go through the webinar, and that just gives a little bit of structure, a little bit of extra information as to what we're doing. We would be delighted for you to ask questions throughout the webinar, and you will find a questions tab on your menu where you can type your question in. Now, depending on the number of questions will depend on how many we get through on the webinar, but we will do our best to give you some sort of answer either on the webinar itself or a little bit after this webinar. And if you want to test out that questions the questions section now, then by all means type in a little comment. Hello, Andrew, if you can't think of anything else, just to satisfy yourself that it is working. If you are incurring technical problems, then you've also got the ability to raise your hand, and by all means have a go at that, and either Alex or Dhruv will do their best to sort out any technical issues as we go along. So the objectives this morning is to take you through 3 items. The first is to simply show you some aspects of a renewables model that we would build in F1, F9. And in order to do that, I am going to show my screen. I've just clicked on show my screen, and you should now be able to see the map sheet of a model that we're going to talk a little bit about as we go through today. So that's section one. We're then going to move on and talk about how we might optimize a renewables model with the senior lender in mind. And having done that, we're then going to look at the impact of that optimized model on equity rate of return. So let's kick off by just saying a little bit about the model that we're looking at the moment. The first thing to say is that all models that we build within F1, F9 follow best practices as documented, for example, in the Chartered Accountants Financial Modeling Code. But in F1, F9, we go one step further in that we promote the use of financial modeling standards, and in particular, we use something called the FAST standard, which you'll find details of the standard, a publicly available standard, which you'll find on its own website, and you can download that and look at that if you want further details. But the impact of using the FAST standard is to build a model that has a philosophy of transparency and navigation. So for example, if I am interested in finding out in the model how something has been modeled, it is relatively simple for me to do that. So if I've gone into the model now, I'm looking at senior debt interest expense. I can see that calculations are supported by ingredients that are called up, are close by, so that I can see immediately what these ingredients are called. I've got nice clear labels. And if I want to investigate any one of those ingredients a little further, I simply use Control left square bracket to hop back to another calculation block. This is a calculation block I'll highlight for you here, where all the ingredients to support that calculation are close, easy to view, easy to understand. And if I want to go back and look at another ingredient, say in row 14, I hop back to another source, and eventually I will get back to an input that has been set up as a hard-coded number on a dedicated input sheet. And as we go through the webinar, we're going to be demonstrating aspects of this model by navigating through the model simply by jumping back on links to useful source areas and talking about their importance to the webinar itself. So having given you a little bit of detail about our approach to modeling in F1, F9, what I'd like to now do is hand over to John, who's going to say a little bit more about the nature of the project that underlies this particular model. John, over to you.
Thanks, Andrew. If we could just be on the map sheet, just in the background, please. But I'm going to start by talking about what it is we're trying to model within this financial model. And we're deliberately trying to keep things simple. We want to focus when we get to the next session with Andrew in terms of optimization and try and make that as clear as it can be. So we're trying to make this a little bit simple. So a few things. The first being we're assuming we've got a development phase, and the development phase will end, then our operations period will commence. We're not going to have any overlap between operations and development. No energy generation, no revenue happening during the development phase. You'll see when we go further through the webinar, we've got a single input, $1 per megawatt hour input, and this is a single input to cover all revenues that we're going to have within this project. So that could be your PPA value, it could be PPA plus subsidy. It's just a single figure to represent what the revenue will be per megawatt hour. We're going to assume that we're going to be funded by senior debt and pure equity only. And when it comes to draw down that funding during the development phase, it's going to be drawn pro rata. And we can also see, and looking at this sheet, we're going to have monthly periods during our development phase, and then the model switches to semi-annual when we go into the operational phase. And just one word to say about that operational phase, the important thing when we get to operations, which will also be our repayment phase, is we want debt service dates to be a model period end date. And we're assuming semi-annual debt service, so they will align with the half years ending in our semi-annual calculation sheets. Moving from there, just a quick overview of the model, and starting by looking at this sheet, the map sheet. We separate input, workings and outputs. One of the real big best practices that a lot of people follow, and it's really very important, very beneficial. So we've separated them, inputs on the left and color-coded in yellow, calculation sheets in the middle. Moving to the right from the inputs, dark grey is the monthly, light grey is the semi-annual, and then moving from left to right again onto our output sheets, again coloured in a different colour. And then we've got this extra box at the end where we've got a couple of sheets that kind of sit outside of that left to right flow, where we've got a check sheet and a track sheet, and we will be looking at the track sheet in the final session, so you'll get to see what that's all about. And just casting our eye down to the tabs at the bottom, you can see the order is the same down there. The colours of the sheets are the same as well. We're really going for the separation and the left to right flow of information through the model. I just wanted to dwell a little bit more now on the input sheets, because we've got three different types of input sheet there. One called IMP, which just means input, one called scenario, one called opt. And again, we've gone for a left to right flow in terms of the inputs. And what we're putting on this first sheet, the input sheet, these are items that we don't expect to change. These are not going to change for a different scenario. They're not going to change as a result of optimizing the model. So we can come to this sheet as the first sheet we populate. We can enter lots of our commercial technical information. If Andrew just skips down the sheet, we've got escalation, we've got capex, operations, senior debts. These are inputs that we can almost fill in and not worry about too much as we go through looking at the scenarios and the optimization. So that moves us on to the scenario sheet. And you'll notice when we get there, very limited number of things on this sheet. And the principle we're following here is we only want to put the things we are going to change by scenario onto this scenario sheet. And so we've got two items here. One very important item, the annual generation in row 13, with two scenarios in this case, one for the P50 and one for the P90. And then there's only one other input we have on here, and that is what is our shareholders' required rate of return. 10% of the P50, and we're basically saying 0, we're not that interested in the P90. And just to think about those inputs for a second, the first one, the generation, that one we expect to have a very significant impact on the model from the inputs flowing through the model, flowing down the cash flow and the income statements. The shareholder required rate of return, that's more of a check. That's a threshold check to see if we can get over it or not. So that isn't going to have the same sort of impact. That's going to be something we will test our outputs against. And then the final sheet is optimization, and this is the one that Andrew will spend time on in the next session. And this is where we house those inputs that are specific to the optimization of the model. And so we've got the leverage percentage, the target ADSCR, and a switch for switching the profile from live to fixed. Very limited number of inputs, and also they're not scenario based. In this case, where we're looking to run a P90 and a P50 scenario, once we've set those optimization inputs, they are not going to vary between the two. So we only need one set. Before I hand over to Andrew, there's a couple of challenges, modeling challenges that are really quite relevant to the optimization that I just wanted to run through so that things are a bit easier and a bit clearer when Andrew starts to talk through optimization. The first of those is what we do about calculating the funding requirement in the model. And this is where many of you will know there's a big circularity issue. And this is in all models of this type. You have to get over this circularity issue. And the reason for this is that the size of the senior facility affects the required size of itself, because arrangement fees and commitment fees are based upon that facility size. So if we can take a look into the con-fin sheet around row 180, just to talk through that point a little bit more. Here we've got some sources and uses. And starting with the sources, and we can see our pro rata drawdown of senior debt and equity. And I think at the moment we've got an 80% drawdown of senior debt, 20% of equity, and a total sources of funding. If you skip all the way down to 193, you can line that up nicely with the uses of funding. So sources are nice and neatly matching up with uses. This is just looking at financial close and then the first few months into construction. But the issue, if we look at where the issue arises, if we look at uses of funding and rows 187, 189 and 188, base construction costs, owner's contingency and agent bank fee, these things are not related to finance. These do not cause a circularity. But what does are the next two lines, the arrangement fee and the commitment fee. Both of those two things are dependent on what the total senior debt facility size is. So if we were to change the percentage of senior debts to equity, what's going on in row 182 would change. We'd have a bigger senior debt drawdown, which would lead to a bigger senior debt facility. And the knock-on from that would be we'd also have a bigger arrangement fee and a bigger commitment fee, which then means we have a bigger uses of funding, which circles all the way back to how much senior debt do we need. So we've got that circularity and we need to break it. And the approach that we take and that you'll see later on in Andrew's session is we do a copy-paste macro, which breaks the circularity. So what is a calculation for total funding requirements is copied and pasted as values, and that becomes the input that then drives the model. And that's what we call a circularity break, and we will see that in action pretty soon. The second challenge is debt sculpting. So we're not going to have a model where the senior debt repayments are like our mortgage. They're not going to be a flat annuity. We want to be able to sculpt those debt payments, so have different amounts over each of the debt service periods as part of our optimization of the model. And the way we do that is by reference to the ADSCR and the ratio. And this is the cell that Andrew's just highlighted. And we use a calculation that says how much debt service do I need in each period in order to exactly achieve that target ratio. And just as a quick reminder on the ratio, this is the annual debt service cover ratio. So this is the ratio of cash available for debt service in a period on the numerator, and the denominator is debt service in the same period. So if we just take a look now again, can we look at financing, row 27? And so this is what we're doing here. We're starting with our target ADSCR. That's the ADSCR we want to achieve. That is an input. It's a reference to an input just to reproduce it in this calculation block. So it's all located in the same place. Next row down is cash available for debt service, the live calculated number in the model. And that's an important point. This is a live figure that's coming through our financial statements in the model. And then a very simple calculation down in row 30 to say how much total debt service, how much principal plus interest do I need to pay in that period in order to achieve a ratio of 1.1. That's the main calculation, but moving on, next calculation block then says, well, what's the principal element of that? So we take total debt service, subtract senior debt interest to give us the principal repayment element. And the next block down is then just saying how much is the total repayment amount, how much are we repaying in each period, and therefore produce me a percentage repayment profile. And this is important because when we want to switch between our P90 and P50, we don't want the calculations to stay live. We don't want the repayments to recalculate because we've changed something else in the model that's going to affect cash available for debt service. So again, and Andrew again will talk this through in a bit more detail later on, again we need to be able to freeze that repayment profile, and again our approach to that is to use a copy and paste special as values mechanism to do it. I'm going to pass back to Andrew, and hopefully he's going to pull some of this together as he talks about optimizing the P90 case.
John, thank you very much indeed. So just a quick summary of that first understanding, getting to know the model. We've taken you through some of the structural approaches, and John has very helpfully picked up on a couple of particular modeling challenges, the funding circularity coping with fees that are dependent on the facility amount, and also the approach to debt sculpting, how we match the debt service of the debt with the shape of the cash flows being generated by the project itself. Thank you very much for that, John. So I would now like to move on and look at optimization itself. I'm going to move to the optimization sheet and just get a couple of basic definitions in place before I start doing something to the model. The first is just to confirm what we mean by P90. P90 is a pessimistic scenario. In this instance, this is the one that says that we're not expecting high levels of power generation. In fact, we're so pessimistic, we're expecting that there is a 90% chance that things will be better than what we have in the model. And our instructions from the lender is to use this pessimistic scenario as a way of being cautious when sizing the debt in the project. Compare that with the P50, which is a 50% chance of things being better than what we have in the model. And that's what we're going to come on to and look at when we think about equity returns. The other definition I'll give you, again, John mentioned this very helpfully, is just the definition of what we mean when we're talking about a ratio, a cover ratio, being cash flow on the top, which I'm going to refer to going forward as CFADs, cash flow available for debt service, divided by debt service itself. And what we're saying there is that for every $1.1 of cash flow generated by the project, we're expecting to use $1 of that to service the debt. Having that in place, we can then look at the 4 inputs that we have got to play with for optimization. We've got my gearing level, the percentage of funding that has been financed with debt that has been set at 80%. And I've had an instruction from the lender that it shouldn't exceed 80%. That is the maximum permissible amount that we can borrow in senior debt. The lender has also specified a minimum ratio of 1.1. I will come on to talk in a little more detail about the live versus fixed repayment profile selection. We don't need to worry about that too much now. But what I do want to talk about is this initial price. Now, my colleague Dhruv has very helpfully set that initial price at a theoretical minimum acceptable price. You can see we've got a number in there with a whole bunch of decimal places after that. There's no way that I would quote a price like that for real. But that price has been set so that if I just reduce that last number from 8 down to 7, then I'm expecting things to happen in the model. I'm expecting that the project no longer to be viable. And so I'm just going to change that 8 to a 7 and hit enter. And what you may notice with some degree of surprise that actually nothing has happened. All looks to be well. But if we look down at the bottom left of my screen, I can see that the model needs to be recalculated. So important point for me to make at this stage, I have set my recalculation to manual recalculation. And that's partly just to generate a bit of suspense in the webinar. You know, I want to get you to think about what might happen when I recalculate the model. So having made that change to the price, I'm now going to do a full recalculation of the model. And what you can see is that that small change in the price has triggered a check. And the check that's been triggered here is that my lowest ratio calculated in the model has now fallen below the minimum allowed. And that's simply to demonstrate that the price I had in there originally was a price that got things to work, but only just my theoretical minimum acceptable price. I'm going to put that back to where it was before on 8, full recalculation of the model, and if I've done that correctly, I get back to things being green once more. Now, I'm going to now replace that theoretical minimum price with one that the lender has asked me to use. So I'm going to replace this with a price that now has some commercial significance. And it may be a market price that the lender has picked up, and the lender may have said, well, I want you to be cautious about that price. But I'm going to bump that price from 36.25 up to 39, a price that I've been asked to use. Update that price, and I again am going to do a full recalculation of the model and see what the impact has been. And if I do that, I can see that my maximum ratio has now jumped up enormously from 1.1 has gone up to 3. And I can also see the impact on my charts, where I've now got a position where I no longer have a level ratio that I started with, and actually things have not only shifted up so that I've got a high ratio in the last period, but the last period itself has shifted to the left. So whereas I started my model with a repayment term that was set at 18 years, you can see that just down below in row 21, I'm now actually repaying significantly earlier. And that's because of the additional cash that is appearing, that means that the debt is being repaid earlier. And what I'd like to do now is just think about, well, what can we do in order to put that chart back to where it was? Are there any of the inputs that we can change up here to push that chart back to where it started? And the input I'd like to look at with you is the gearing, is the 80% gearing. And so, Alex, at this stage, I'd like to run the second poll, please. If you could put a second poll up on the screen for me. Let's just wait for that poll to appear. So the question I'm asking you to consider now is, do you think the gearing or the leverage, that 80%, would that need to go up or down to help us restore level ratios of 1.1? And I'm going to ask you to just take 10 seconds or so to select an answer. Another 5 seconds perhaps for answers to come in. And Alex, let's show the results of the poll. So I've got a mix of results, but it looks like a clear majority of people suggesting that I should bump the gearing, bump the leverage up. So I'm going to go with the majority. Thank you for that, Alex. Let's return to the model. And I'm going to use trial and error for now, simply to prove, which would be more sensible. Is it more sensible to go up, more sensible to go down? I'm going to pop in a value of 85%. Change that to 85%, full recalculation of the model, and let's see what happens to the chart. I notice that my ratio here, my maximum ratio has gone up, but if you take a look at the chart, I can see that things have moved in the right direction. I'm moving things toward the right. I'm moving back to my 18-year repayment profile. But there are also a couple of other more concerning things that have happened. I've got a check that's been triggered in row 28. That check is simply making sure that I'm not borrowing more than what the lender specified. Now, I'm going to ignore that check for the moment because there might be a possibility I could go back to the lender and perhaps argue for higher levels of gearing. So I'm going to live with that check for now. But let's look on at another check that has been triggered, which is that my senior debt drawdowns are now exceeding the facility amount, are now exceeding the amount that I've agreed, the total size of the debt. And this brings us back to what John was saying about the need to run a circuit breaker in order to avoid your model being circular with the fees that are sized off the facility. I am simply going to take a copy of my drawdowns and do a paste special values in the cell below. Paste that down so that now my drawdowns exactly matches the amount that I have agreed to borrow from the lender. Full recalculation of the model, and look what happens. Because with that new facility amount that I put in, that higher facility amount, that has bumped up the fees that are charged on the facility, which means that I need to draw down more senior debt. So what do? I repeat the process. I take a copy, paste special values into the cell below, recalculate the model. And what I will hope you will notice is that the difference between the drawdown and the commitment gets smaller and smaller. And at which point you might say, well, Andrew, the mechanics involved in doing a paste special values, open to error, why don't you record that as a macro and just hit the button? And we have done that here. We've got a button that records the macro. And those of you interested in the VBA coding in order to support this macro, you will find that documented for you on the handout. So going forward, I'm simply going to hit the button. That continues the paste special value routine, and I'm going to continue a couple more times until I'm satisfied that I've got something where the difference between the two is tiny, an immaterial difference. So I'm now in a position whereby my funding requirement has moved up. I've moved the chart in the right direction, but we're still not quite far enough. So I might continue with my trial and error. Let's put this to, let's say, 89%. Recalculate the model, look at the chart. The chart is now getting much closer to my level ratios, but I need to rerun the circularity brake in order to get things such that I've sized the debt appropriately. And so now that's given me a second answer, and I could continue refining this in order to get things as close as I can. From work that I did earlier, I seem to remember that 89.1581% gave us something that was pretty close to optimal. Look at your chart there. There's now only a tiny difference in the ratios, and if I rerun that paste special values routine, I'm seeing something that is now getting nice and close. The difference being only a 1.1001, just a smallest nudge from one to the other. So that's how I might manipulate the model by changing the gearing, changing the leverage. But I still have the problem that I am above the maximum permitted amount, and having consulted with the lender, they are holding a position that really levels of 89, nearly 90% is too much for them to bear. The risk is too great for them to bear. And so they've instructed me to go back to 80%, which I've done now, recalculate the model, and rerun the circularity brake, which will get me back to where I was when I first started this routine. Okay, I'm back with my ratio of 3. I've got the shorter debt period. And now I'm going to look at a second way of optimizing the model. So in the event that we can do nothing with the leverage, the next ingredient or the next input we can look at is, well, what if we accept that we are not going to achieve a minimum ratio of 1.1? What if we allow that ratio to float? And so, Alex, I'm going to ask you please to run the second poll now, which is to do with changing the ratio. Alex, if you could put that up on the screen, please. So my second question for you to consider is, what would need to happen to my target ratio in order to restore level ratios, in order to give that chart back to a level chart, but accepting the fact that the new level ratio would no longer be 1.1. I'm going to ask you to vote again. Do you think the ratio should go up or should it go down? I'll give you 10, 15 seconds to complete that. Alex, let's just give people another 5 seconds, please. And now let's show the results. Again, nice mix of results, but the majority seems to tell me that I should go with a higher ratio. So again, I'm going to run with the majority. Thank you for that, Alex. Alex, let's go back to the model. And again, I'm going to use trial and error. Let's see whether the majority was right. I'm going to put the ratio to 1.2, a full recalculation of the model, and I can see the chart has shifted itself to the right. It's moving in the right direction. I also note with some degree of comfort that nothing has happened to my drawdowns because we're not having any impact on the amount of debt that we draw down. We're simply looking at how effectively, how quickly we are repaying that debt. So I can see a degree of comfort that I've had no change there. Again, I might play around with that ratio to try and get this as close as I can. From work I did previously, I came up with a figure of 1.2274, full recalculation of the model, and that was giving me a level chart at around the 1.2274 to 278, and I could work on that, refining that to get that a little closer. I can imagine that a number of you are also thinking at this stage, well, hang on, maybe there's a better way, a way of getting to that solution more quickly, and you can deploy a goal seek routine here. And details of how you would set up that goal seek routine and the VBA coding you'd need to turn that into a macro are also on your handout. So by all means, take a look at that, and you can get some more details there. But for now, I am going to move on. I'm going to assume that I've done everything I can now to optimize the project from the lender's point of view. And so I'm now going to prepare the model, ready for John to take back over and look at the impact on equity. And the first thing I need to do is to take my senior debt principal repayment profile and fix that in the model. I no longer want those numbers to change because I've now found the numbers that I'm happy with. So if I go off to my financing sheet, let's find where we have modeled that repayment profile, and it's in this calculation block here, running from rows 44 down through to 51. And what we've got in this block is we've got a couple of repayment profiles. We've got the repayment profile that we have just calculated. This is the one that the model has just calculated. And then beneath we have got space to put a hard-coded version of what we have just calculated. And you can see that I've also got a check down the bottom here to say what's the difference between those two scenarios. Now I want the difference to be 0, so all I'm simply going to do is to go back to that first scenario, take a copy of the profile, and we're going to do a paste special values in the row down below. Paste special values, paste those values down, full recalculation of the model, and I hope to see that the difference between the two has now has now vanished. In other words, there's no difference between what the model has calculated and what I have got stored as a hard-coded value. To now run the model using that fixed scenario, I'm going to make use of the index function deployed for a simple scenario selection. At the moment, the active profile is being driven off that first scenario, what I've got in row 47. In order to change that to the second scenario, I need to change this number 1 to the number 2. I'm going to hop back, take me all the way back to my optimization sheet. I've got a neat little drop-down menu where I can choose option 2. I now know that the model is being driven off the fixed scenario, and then when I do a full recalculation of the model, I'm expecting, if I've done that correctly, to see absolutely no change at all, because what I've simply done is taken those numbers and pasted them down. There should be no difference between the two. At which point, let me check in with John just to make sure that he's happy to take back control of the model, ready to assess the impact on equity returns. John, are you happy?
I think I am, Andrew. Thank you very much.
That's wonderful news, John. Okay, back to you.
Okay, so we've optimized debt for the P90 case. So the next thing we want to do is see what this means for our P50 case. So what we're going to do to help us with that is we're going to use the track sheet, which I mentioned briefly earlier on. And this is a standard structure, a standard sheet that we use at F1, F9 very frequently. We use it both for our internal QC process, and we also set our clients up with it as well so that they can make use of it. And let's just take a look at this sheet. So this is the track sheet, and what we have on here are live values from the model, and we can see we're showing the cash flow from rows 8 down to 39. And the area I think Andrew's about to highlight, columns E to H, these are the live values in the model at the moment. And so these are currently our P90 values. If we look in A1, we can see we've got a bit of help there telling us we're still set into P90. So we've got live values for cash flow, and if we take a little look further down, we've also got some outputs. The live outputs from the model summarized down below, and hopefully familiar things. We've got our shareholder return, our maximum minimum ADSCR, whether we're showing any error checks. We've also included some inputs. So percentage funding requirement, target ADSCR, our value per megawatt hour, and our generation numbers. So hopefully, in the context of what we've spoken about today so far, very useful information in terms of what's going on in that P90 case. And what we do with the track sheet, and Andrew can do this for me in just a second, is we want to store a version of these live values, these current P90 values, and paste them into columns N or O and paste them as values so that we've got a permanent store of this information. And of course, hopefully you can imagine you could take this a lot further. You could include income statement and balance sheet. You could include all of the outputs your model's showing. You could include all of the inputs your model's showing. So one of the ways you can use this track sheet is for Audit Trail, and that's usually how we set it up for clients, so that as they go from one version to the next, as long as they're copying and pasting in a store of values, they're going to get that Audit Trail. But what we're going to use it for in a moment is to look at the differences we're going to generate between P90 and P50. So Andrew, could you make that copy for me, please? Just so we've got a P90 set of values stored.
Oh.
And again, there's a macro we can use to do this for us, but at the moment we're just doing everything manually, just so you can see what it is we're doing. And if we recalculate now, we'll be comparing live values in column H with hopefully identical values in column O, and all of the orange, all of the difference information and difference percentages you could see in columns K and L. It's all disappeared, so everything is completely in line with the P90 case that Andrew just solved. So the next thing to do is let's go and look at turning it on to P50. So to do that, we need to go to the scenario sheet. And on the scenario sheet, we've got a similar index function, which I think Andrew just showed us, based off of F5, where we choose our scenario. So if we change that to P50, don't hit recalculate quite yet. So now we're set into the new case. And what we're expecting is the model will only have two differences now. It will only have a difference in terms of what's happening in row 13, annual generation, and what's happening in shareholder required rate of return. And before we go through to the track sheet and see what the differences are, it's really important at this point that we start to think about what differences are we expecting to see. When we go from P90 to P50, we start looking at our cash flow and our outputs. What are we expecting to see changing? Because if you go to that and look at the changes first, you're influenced by what you're seeing. We want to form the view first, then move to look at the differences. And just talking through what I'm thinking, we've got a new generation profile. I'm expecting to see an increase in generation, which will translate into an increase in revenue, which should increase my cash available for debt service. And that's row 13. Row 15, as discussed before, I'm not really expecting to see anything change because that's a check against an output. So let's go through to the track sheet and see if that hypothesis is working for us.
Would you like me to recalculate, John?
Yes, please, Andrew. So Andrew's now recalculated and the track sheet is now highlighting to us where we've got differences. And the job now is to basically work down this sheet and, probably with particular focus, I think, on the cash flow and make sure we can rationalize and we're happy with all of these differences. And this job for me, it's a 3-part job. And we look at every row, whether there's a change or there's not a change. And we ask ourselves one question, which is, do we expect a change, yes or no? And, looking at EBITDA, I'm going to say, yes, I was expecting a change because the generation had increased, revenue should have increased, therefore I do expect EBITDA to change. Second question, if we've come up with a yes, is do you expect it to go up or do you expect it to go down? So again, here with EBITDA, I was indeed expecting EBITDA to increase because revenues have gone up. So that makes me happy and I feel I can move on to question 3. And question 3 is the hardest one and probably we need to spend a bit more time than we've got right now to do this one, and that is, does the quantum look right? Does an 18% increase in EBITDA equate to whatever percentage increase I'd made to my energy generation? And we work our way down the cash flow asking those questions. So just looking down, and in terms of the ones I want to take a look at, we've looked at EBITDA, that looks fine to me. Moving down to corporation tax, there's a change there. Revenues have increased, therefore I would probably expect that taxation is going to increase as well. So again, nothing there to concern me. If there was something that concerned me, if I didn't like the look of that, or indeed I took it a step further and thought, oh, hang on, that difference percentage doesn't look quite right, we need to do the investigation work. And that investigation work will have 2 outcomes. One will be, I understand this model and this scenario and this case and this commercial situation better, and it's right, or it's wrong. Something needs to be rectified in the model that needs to be fixed. Both those outcomes are big wins in my book. And the other thing I'd want to focus on in terms of the cash flow are the things we really don't expect to change. Andrew talked us through freezing the senior debt drawdowns and senior debt repayments. So I am not expecting my senior debt drawdown in row 18 to change, nor am I expecting my senior debt interest or principal repayment in rows 23 and 24 to change. I'm now feeling reassured we have successfully frozen those values at the P90 values, which is what we wanted. So moving on down from the cash flow to the outputs, and let's look at the really important one, which is the shareholders return. We can probably remember we had a requirement for 10%, and down here at row 44, we can see that in P90 we had a lower return, and again, rationalizing this, we would expect to achieve a higher return in our P90 case because the revenues have gone up. But unfortunately, that rate is not at our 10% threshold. We're at 8.15%. And from here, it's really a question of, is there something we can do now that isn't gearing, that isn't cover ratio, that can help us get from 8.15 to 10? And, we work in different jurisdictions, different countries. We see a real variety of different parameters that developers and investors change in order to try and move that figure. We're not going to do it right now, but just to say that there's going to be different types of change. You can have a change that takes effect only in P50, doesn't affect P90. That's the easier one because you can make your change in P50, hopefully get yourself to where you need to get to. You don't need to go back and resolve P90. But then there's going to be changes that do affect P50 and do affect P90, and that's where things get a bit more complicated because you're going to need to solve P90, as Andrew demonstrated, go into P50, then look at what we can change to get up to 10%, make those changes, and then we have to switch back into P90 again and see what the impact's been there. Redo the optimization at P90, switch back into P50, and then see, are we now satisfying P50 as well? And chances are you're going to need to go round that loop a number of times in order to get to an optimal position. I think that's enough content for one webinar. I think there's been quite a lot covered and quite a lot for people to think about. So I'm going to pass back to Andrew to wrap up the presentation.
John, thank you very much for that. So quick summary, the P90 optimization that I talked you through, followed by the critical role of the track sheet in terms of assessing the impact not only on the equity rate of return, but also as a sense check on the remainder of the model. That brings us to 10 to 12. We do have time for some questions. So while I am talking, I think my colleagues are just having a quick look at the questions that have come in, and I am going to check in with them to see whether there are any questions that we want to pull out and discuss in the last few minutes of the webinar. John, what have we got?
I have a few questions. So I've got one from Andreas, who is asking, can you clarify how the optimization inputs and gearing and ratio affect return? Which I think I can probably answer.
Perfect, John. Go for that.
Optimization sheet, please. So yeah, hopefully some of this came out of the discussion. So looking at them in turn, I think with gearing, in all my experience, and I'm sure there could be an exception under certain circumstances, but in all my experience, the higher the gearing, the better. So the higher the gearing, the better the shareholder return. And what that would mean is, in terms of solving this kind of model, you would definitely start off, first step is, let's put the target ADSCR at the lowest possible level, because that's the level that will allow you to optimize gearing as high as it possibly can be. So first step would definitely be, more gearing, better return, so set the target ADSCR at the lowest level. The situation we've got here that Andrew's run through is that we've exceeded maximum gearing and therefore we're limited, and therefore we've started playing with the ADSCR. And so the answer for the ADSCR is the higher the ADSCR, the better the return. And the reason for that is that the higher the ADSCR is, the slower your debt service is. And if your debt service is slower, it means you've got more cash available to distribute to shareholders. As I mentioned, it is ranked, I think, that you would not want to compromise gearing for ADSCR, so you would start with gearing first and then move to ADSCR. But for both, higher gearing, higher return, higher target ADSCR, higher return.
Thank you, John. Yeah.
And I do have another question, Andrew, which I think is probably one for you, which came in from Malcolm, which was, can you explain what the colours are for, what the blue and the red that we're seeing on the screen in terms of font colours?
Yes. So let me do that as quickly as I can. So the first thing to say is that all the colours, all the font colours have a meaning, and I'm expecting only to see 3 of them. One is the blue is for an imported link, and the important thing about that is that when I hop back on it, I know it's going to take me to a different sheet. And when I do hop back on it, it takes me to a calculation that has been marked red. So there's the second font, red font, for calculations that have been exported. And that's mainly for the modeler to know that red is a warning red to tell the modeler that calculation should be deleted with great care because there are dependencies on that calculation elsewhere in the model. So blue for what we call imported links, red for exported calculations, and then we use black font color for anything else. That's our default color.
Thanks, Andrew. While I'm reading out the next one, if you could just switch us back into P90 and recalculate.
I certainly can do that. P90, here we go.
And the next question was from Charlotte, who says, it looks odd that the graph shows loan life only slightly shorter than 18 years, but the calculation suggests it is half at 9 years. So there's a quick answer, but I'm going to give the longer one because it's a good question. What we're showing here, if we look at the chart, the target ADSCR, the hashed red line, is basically showing us the full term of the loan. We expect it to start at the start of that line and final repayment is at the end of that line. So I think when we've been looking at Andrew's charts of ADSCR and he's been saying, you know, we're short, it's short based on the 18-year repayment term. And I think what's caused the confusion here is the line, row 22, senior term debt loan life. And I think probably we need to add a word in there because that is senior term debt average loan life. So that is the number of years that pass from drawdown until half the time-weighted principal is repaid. So we would expect that one to be somewhat shorter. And I think the confusion there has arisen from the label, which I think we will change. And just to say, in terms of why that's there, that is related to this ADSCR point about can we increase the ADSCR to slow down debt service to allow us to pay more distributions. What could kick in with the funders, if you are lucky enough to be in that situation, is that at some point they may look at the average loan life and say, it's just too long, we're not comfortable with how quickly you're repaying our loan, it's too slow. And that's why we had that in there as an indicator.
Good. It's now 4 minutes to 12, so I propose that we stop the Q&A at that point, but thank you very much for your questions, much appreciated. And we will do our best to get answers to any other questions, but we'll do that by email. And if you think of follow-up questions, then by all means, drop us a line at info@f1f9.com, and we'll see what we can do to answer your questions. So let me wrap up. Thank you very much for your kind attention over the past hour. Quick reminder of what we were covering. Our 3 objectives for the webinar were to give you a quick guide as to how in F1F9 we structure renewables models. We then followed that by looking at optimization for the lender at the P90 scenario, and finally we looked at assessing the impact on equity. Thank you very much for your kind attention, and I look forward to hearing from you soon. And if you wish to find out a lot more about putting such models together, may I recommend our forthcoming Financial Modelling for Renewables course, next one in London on the 15th and 16th of January. Thank you very much, everybody. We're going to close the webinar down now.
Thank you. Thank you very much.